Hey everyone, it's Friday morning, March 28th, and welcome back to Capital Markets Quickie. I'm your host, Endrit Sella, here to break down yesterday's market action in just 2 minutes. Before we get started, a quick note, today's episode is sponsored by AMF Capital Asset Management Frankfurt. For tailored investment solutions and top-quality mutual funds, visit amf-capital.de. So, here's a question. What happens when tariffs go from talk to action? Well, the stock market blinks. Hard. The stock market yesterday slid lower after President Trump moved forward with a 25% tariff on imported cars, set to kick in this April. And just as markets were trying to digest that, Trump warned that even bigger tariffs could be coming for Canada and the EU if they collaborate to harm the US economy. So yeah, not exactly calming words. The Standard & Poor's 500 fell about 0.3%, the Dow was down a similar amount, and the Nasdaq led the losses, dropping more than 0.5%. Auto stocks? Not a good day. General Motors shares tumbled 7%, Ford dropped nearly 4%, and Stellantis slipped over 1%. Interestingly though, Tesla actually ticked up, likely because it's less exposed to import tariffs compared to the traditional automakers. Now, zooming out, investors are still wrestling with what all of this could mean for the broader economy. There are growing concerns that these tariffs might fuel inflation while slowing growth, and that's a dangerous combo. All eyes are now on today's Personal Consumption Expenditures report. That's the Federal Reserve's preferred inflation gauge. We'll also get a peek at consumer spending, and that'll give us more clues about how households are holding up. Fed Chair Jerome Powell recently said the price spikes from tariffs should be transitory, but not everyone is convinced. St. Louis Fed President Alberto Musalem even hinted that they might need to reassess that thinking. That's it from me for now. Let's see what the data tells us next. I'll catch you tomorrow morning, right here on Capital Markets Quickie. Take care.